Stop scrolling and hang tight. If you're in your 30s or 40s, this could be the moment that decides whether you're chasing wealth or building it. Hold it right there, because the next 90 seconds frame everything that follows. If you click away too soon, you'll miss the single detail that explains why the money pipes of the old system are straining, and why XRP holders could be standing in front of a revaluation event that looks like a trapdoor opening under everyone else. At the time of recording, XRP is trading in the $3 range. For context, XRP is around that level right now. If you're watching later, price may have shifted, so lock onto the mechanics more than the number. None of this is financial advice. Always do your own research and talk to a qualified professional. Make sure that you like and subscribe this video. It really helps me get the message to the masses and is greatly appreciated. Here's the setup in plain language. The global financial system has been floating on cheap borrowed money for over a decade, and a huge chunk of that carry trade has been funded in yen. Institutions borrow low in Japan, swap the exposure, and chase higher yields abroad. Estimates on the size of this carry problem run well into the double-digit trillions. You'll hear numbers like $10 trillion and up when you add the leverage stacked on top. That trade works as long as volatility stays calm, and the cost of rolling those positions doesn't jump. But when rates move, currencies lurch, and liquidity thins, the math flips from free money to fire drill fast. Give me 60 seconds on why that matters. When a crowded trade unwinds, it's not a gentle parade of sellers. It's a scramble to get through the same door. First, funding squeezes. Then collateral values wobble. Then forced selling hits the instruments that were never supposed to be touched. The IG bonds, the safe equities, the currency hedges. Each de-risking wave begets the next. That's when you see the odd prints, the flash air pockets, the how did that gap even happen moves on assets everyone assumed were liquid. The story you'll hear on TV is sentiment, but beneath the surface, it's plumbing, where cash can and can't flow at speed. Zoom out for a second. The bond market is the foundation of everything. And for the last 2 years, we've had a rolling earthquake. Yields jerk higher, then lower, then higher again. Dealers manage inventory tighter than ever because balance sheet is expensive. ETFs promise intraday liquidity on top of underlying bonds that don't trade intraday. Meanwhile, derivatives towers reference those same instruments. When you get a shock, a currency spike, a policy surprise, a funding hiccup, liquidity doesn't gradually fade. It vanishes in chunks, like a shoreline when the tide rips out before a wave. Now keep me for just one more minute, because this is where the path forks. In an orderly unwind, players reduce risk over weeks, spreads widen a little, markets adjust, and we all move on. In a chaotic unwind, basis trades snap, margin calls cascade, and cash flees to the shortest, safest paper it can find. The difference between those two outcomes is not a press conference. It's whether the system has enough neutral, high-speed liquidity bridges to absorb shocks without forcing fire sales. Enter XRP's role in this conversation, not as a meme or a moonshot, but as a piece of infrastructure. The world's payment rails were built for a slower age. Vostro accounts trap trillions in idle liquidity just to make cross-border settlement doable. When stress hits, trapped liquidity becomes painful liquidity. A bridge asset designed to move value in seconds with finality is not a luxury. It's a pressure valve. That's why you keep hearing about Japanese groups like SBI, central bank pilots, and the broader Asia corridor experimenting with real-time settlement. They're not chasing hype. They're trying to keep capital mobile when old pipes clog. Before we go deeper, here's a clarity line to keep this evergreen. Exact prices are noisy and temporary. Plumbing is persistent. Whether XRP is $2 or $5, the question that matters is, does the world need a high-throughput neutral bridge to keep value moving when traditional rails lock up? If the answer is yes, then the direction of travel is set, even if day-to-day candles wobble. Let's talk about the pressure points visible right now. Currency volatility is back on the menu. Japan has to walk a razor's edge, keep domestic funding cheap, and they export volatility. Tighten too fast, and they risk detonating the carry that props up global risk. In the West, debt service costs are chewing through budgets, which limits how much cushion policymakers can deploy without telegraphing a pivot. Dealers keep risk lean. ETFs keep promising. Intraday escape hatches. Algos keep harvesting tiny spreads until the moment those spreads disappear. It's all fine until it isn't. Stay with me, because the next 60 seconds connect that macro to your bag. When liquidity thins, the market doesn't distribute risk evenly. It attacks the weakest links, crowded carry, mismatched hedges, the assets everyone thought were safe to fund against. In crypto, it attacks exchanges with poor inventory and shallow books. What happened in past cycles was simple. Exchange balances of high-utility assets drifted down, and then during stress, they gapped lower as large players pulled coins into custody or programmatic pools. That dynamic doesn't need a bull market. It needs a reason to hold inventory off exchange. Regulatory clarity, institutional pilots, and real settlement testing are precisely that reason. At this point, you might be thinking, okay, but how does that create a snap? Here's the intuition. Imagine a shallow lake feeding a city. On normal days, small boats ferry water all day long, and nobody notices the level dropping. Then one dry week hits. The lake level is already low and the city still needs the same water. Suddenly, every boat has to bring more per trip, but there aren't enough boats. Price isn't about hype at that point, it's about rationing. The system resolves rationing with a higher unit price so fewer units can carry the same value without destabilizing the lake. In payments, that unit price is the price of the bridge asset. You don't need conspiracies to get a repricing. You need a mismatch between the value that must move and the units available to move it without shaking the market to pieces. One more minute, because there's a psychological trap to avoid. Retail hears liquidity crisis and thinks doom. Pros hear liquidity crisis and think, who will be forced to sell me good assets cheap? The bridge from fear to opportunity is understanding time horizons. In the first 48 hours of a squeeze, everything red prints together. In the next 30 days, assets tied to utility reprice faster than assets tied purely to sentiment. Over the next 12-24 months, rails that reduce trapped capital and settlement friction tend to earn adoption premiums. If you internalize that latter, you stop trading headlines and start positioning for the mechanism. Let's tie this back to your day-to-day decisions. You don't control the BOJ, you don't control treasury auctions, you do control whether you panic at the first air pocket or you treat volatility as information. Watch three tells: cross-asset basis dislocations, exchange inventory trends, and the divergence between on-ledger settlement growth and price. If settlement pipes are humming while price chops, that's a signal. If exchange balances fall while custody and programmatic pools rise, that's a signal. If funding markets wobble while real-time payments volumes hold up, that's the signal. Now, because you've stuck with me this far, here's the payoff you were promised at the start. The liquidity snap isn't about predicting a specific day. It's about recognizing that the old rails become brittle under stress and the world quietly shifts toward anything that keeps value moving with less collateral locked in the walls. In that shift, a neutral bridge asset stops being a speculative toy and starts being plumbing. When that identity change gets priced, it rarely drips in slowly. It tends to step because markets don't reward the latecomers with gentle entries. Let's go deeper and map out how this actually unfolds. Because it's one thing to talk about a liquidity snap in theory, but the mechanics of an unwind determine whether it's a soft landing or a free fall. And if you hold on for the next 60 seconds, you'll see why most people completely miss the signal until it's too late. Here's the sequence. A carry trade doesn't just collapse in one violent move. It breaks in stages. Step one is recognition. Traders start to notice that hedging costs are eating more of their returns, or that rolling their yen borrowings forward suddenly costs more. At first they shrug. Maybe it's seasonal, maybe it's just a temporary spike. But then step two hits. Basis spreads widen, and arbitrage desks that normally keep things tight step back. That's when liquidity providers thin their quotes, and suddenly the same trade costs multiples more to put on than it did weeks earlier. From there, step three is forced adjustments. Leveraged players can't sit and wait, they trim positions. When those trims hit, it's not just Japanese government bonds, it's treasuries, corporates, equities, even FX swaps. And because markets are globally entangled, the pain doesn't stay in Tokyo. It radiates across every asset class that fed on that cheap yen liquidity. If the unwind stays orderly, you get choppy price action, a few scary headlines, and eventually a reset lower in risk appetite. If it spirals, you get cascading liquidations, margin calls, and the kind of air pockets that make investors feel like the floor just disappeared. The irony? Both outcomes create the same opportunity for those who are positioned, volatility as a transfer of wealth. Now listen closely, because this next 60 seconds is critical. In the middle of that storm, liquidity doesn't disappear completely. It reroutes. Markets hunt for assets that can absorb flow without seizing up. And here's where the XRP narrative becomes less about speculation and more about structural necessity. Japan's SBI has been vocal for years about building real liquidity pools around XRP, precisely because they know that if the yen carry ever snaps, Japan will need neutral settlement tools that keep money moving when legacy rails freeze. Add to that the Bank of Japan's delicate balancing act. They've hinted at tightening to defend the yen, but they can't afford to trigger mass unwind chaos. That's why parallel conversations about a digital yen and blockchain rails are happening behind the scenes. It's not hype. It's contingency planning. And in every serious pilot, the question comes up: how do we connect domestic liquidity to global flows without locking trillions in idle accounts? That's the exact problem a bridge asset like XRP solves. Don't click away yet. The real shocker is just around the corner. Because when you put these threads together, you see the setup for what I call the utility bid. During chaos, most assets fall. But bridge assets that facilitate liquidity movement can rise, not because of sentiment, but because demand for throughput spikes. That's a completely different dynamic than a meme pump or speculative cycle. It's the market repricing utility under duress. Here's a picture to hold in your mind. Imagine global finance as a set of highways. For years, traffic flowed freely because gas was cheap. Suddenly, gas prices triple and traffic snarls. Everyone's looking for shortcuts, side roads, anything to keep moving. Now imagine a brand new express lane that was ignored when traffic was smooth. Suddenly, that lane isn't just valuable, it's essential. That's XRP during a liquidity squeeze. It's not about hype, it's about being the lane that actually clears the jam. And one more thing, institutions are not blind to this. SBI, RippleNet partners, even conversations around the BOJ's digital strategy are already aligning around alternative rails. They don't announce adoption the day they need it, they prepare years in advance, and then they flip the switch when crisis forces their hand. Retail sees the headlines after the fact. Smart money watches the plumbing before. So here's your retention spike. Don't miss this next part, because it's the single most important trigger behind why XRP could reprice in a way that blindsides everyone. It's not speculation, it's not hype. It's the mechanics of how trillions unwind and where that liquidity has to flow when the old pipes clog. Let's zoom in on what happens when liquidity becomes scarce, because this is the part where psychology meets mechanics. If you hold on for just 60 more seconds, you'll see why most investors misread this moment entirely, and why XRP's setup is unlike anything else in this cycle. The first reality is that exchange supply is shrinking. Every week, we see more XRP flowing off public exchanges and into custody solutions, institutional wallets, ETF custody accounts, and long-term cold storage. On the surface, price action looks quiet, but underneath it's like a shallow lake in a drought. You can still fish, you can still boat, but the water level is dropping, and sooner or later, one big splash drains the whole system. That's where retail panic collides with institutional strategy. Retail investors sell into weakness. They see a dip, they feel fear, they offload tokens for dollars. Institutions quietly scoop those tokens and move them into custody, where they won't reappear in circulating supply. The average person doesn't realize that every coin leaving a liquid exchange is one less coin available when demand surges. And when ETFs or large banks absorb those flows, it's like plugging a drain in that shallow lake. The water doesn't refill, it only shrinks faster. Now don't miss this part. This is where the psychology gets brutal. Most people expect revaluations to look like a smooth climb. Green candles, pullbacks, then more green candles. That's not how liquidity crunches resolve. They resolve in phases. Phase 1 is the liquidity crunch itself. Exchange depth evaporates, spreads widen, and even small orders move price more than they should. Phase 2 is utility scaling, where the actual use case for settlement assets like XRP collides with the fact that supply is constrained. Transactions demand throughput, and suddenly the asset isn't just being held, it's being used. Phase 3 is institutional dominance, when ETFs, banks, and global payment systems treat XRP not as a speculative trade but as infrastructure. At that point, retail doesn't set the price anymore. The flows do. This is why I call it a shallow lake moment. Imagine you're standing at the edge of that lake. Retail is splashing around, thinking it's endless. Institutions are quietly digging channels to redirect the remaining water into private reservoirs. By the time retail realizes the level has dropped, it's too late. The lake bed is dry, and the only ones holding water are the institutions who planned ahead. Let me make it even clearer. During past bull runs, XRP supply on exchanges routinely shrank during the run-up, but back then it was driven mostly by speculative whales and retail wallets. Today, it's different. Custody structures for ETFs, private funds, and banks are the ones absorbing the flows. That means when the price pressure hits, there's not just a lack of liquidity. There's a structural wall between retail and the supply they think exists. It's not coming back onto the exchanges. It's locked in custody. And here's the kicker. In a crunch like this, you don't need every investor to want XRP. You just need a few percentage points of global flow to re-rate the price. If trillions in global settlements, ETFs, and cross-border liquidity routes demand a bridge asset, and circulating supply is a fraction of what it once was, price doesn't just rise, it gaps. That's the part no one is prepared for. Stay with me, because the final tease is right around the corner. In just a minute, I'm going to tie this into why XRP's revaluation isn't about chasing the next pump, but about surviving the next liquidity freeze. Most people will treat it like another hype cycle. The few who understand the phases, crunch, utility, dominance, will recognize it as structural. And here's the psychological trap. During the crunch, you'll hear the loudest voices saying it's over, that XRP failed, that liquidity dried up and adoption stalled. That's the noise. Meanwhile, behind the scenes, liquidity reroutes, custody builds, and settlement use cases scale. Then, when the revaluation phase hits, those same voices chase at higher levels, wondering how they missed it. It happens every cycle, but this time the structural backdrop is far bigger. This isn't just crypto volatility. It's the merging of global finance with blockchain rails. The lake is draining, and when the rains come, only the channels already dug will capture the flow. All right, you've made it this far, but hold tight because the ultimate reveal is about to hit in the final section. That's where we put XRP side by side with Bitcoin and Ethereum, map it against historical cycles, and explain why this isn't speculation anymore. This is structural revaluation, and it's the reason most investors will regret blinking at the wrong moment. For just a second, and picture this with me. On one side, you've got Bitcoin, the digital gold narrative. It's a store of value, it has scarcity, and yes, it leads the market cycles. On the other side, you've got Ethereum, the smart contract network, the foundation of DeFi, NFTs, and tokenization experiments. But sitting right in the middle, and this is what most people still don't grasp, is XRP. Not gold, not contracts, but the plumbing itself, the bridge asset for global value transfer. And when the system breaks, it's the plumbing that gets revalued, not the decoration. XRP's valuation isn't about speculation anymore. It's about how much global settlement flow it ends up routing. Imagine judging Amazon in 2002 only by book sales. That's where we are right now with XRP. Now zoom out, look at the macro backdrop. Rate cuts are on the horizon after one of the most aggressive hiking cycles in history. Every prior cycle tells the same story. Liquidity dries up, fear peaks, then central banks pivot, and liquidity surges back in. And when liquidity returns, it doesn't dribble into safety. It floods into risk assets. Stocks rally, real estate rebounds. And crypto doesn't just recover, it goes parabolic. In 2013, cheap money fueled Bitcoin's first mania. In 2017, a flood of liquidity drove XRP to over $3. In 2021, stimulus and zero rates sent everything into the stratosphere. Now here we are again, but this time with custody, ETFs, and real-world utility as the accelerants. If you hold on for just 60 more seconds, you'll see why XRP's setup is different this time. Bitcoin will still capture headlines, sure, Ethereum will still attract developers, but XRP is the only one directly positioned as infrastructure for global liquidity. Banks don't need Bitcoin to settle payments. They don't need Ethereum to clear cross-border flows. But they do need a neutral, fast, and scalable settlement layer, and that's XRP's entire design. Here's where psychology crushes most people. They've been conditioned to expect XRP's moves to look like the past. Hype, FOMO, pumps, and dumps. They think holding is just about waiting for another speculative rally. What they miss is that this next phase isn't about hype at all. It's about institutions absorbing supply permanently. ETFs don't buy to flip. Banks don't integrate to speculate. They accumulate for infrastructure. That's the phase shift most retail won't recognize until it's already too late. Think about it this way. Bitcoin is scarce at 21 million coins. Ethereum is scarce only when staking locks it up. But XRP? Its scarcity isn't just programmed, it's engineered through adoption. Every settlement that requires XRP, every custody wallet that swallows supply, every liquidity hub that reroutes flows, pulls coins off the open market. Scarcity by utility is stronger than scarcity by design. It's demand that doesn't care about hype cycles. Now let's tie this back to history. After the dot-com bust, everyone said the internet was dead. Then came Amazon, Google, and Apple's dominance. After the 2008 crash, people said finance was broken. Then came fintech, mobile payments, and global digital rails. Every time a system cracks, the infrastructure of the new system surges. That's exactly where we are now. XRP is the infrastructure. Don't miss this. This is the silence before the storm. Right now, it feels calm. Price is consolidating, headlines are noisy but not explosive, and most investors are distracted. That's always how it looks right before a revaluation wave. And when it hits, it won't wait for people to be ready. It won't climb politely. It gaps higher, and those who didn't hold through the silence get left behind. So ask yourself this. Do you want to be the person who panicked at $3 and missed the re-rating? Or the person who understood that structural adoption doesn't care about noise? That's the line that separates regret from wealth. Let's be crystal clear. This is not financial advice. Always do your own research, consult professionals, and make decisions based on your own circumstances. But history shows us the pattern, and XRP's positioning shows us the future. Bitcoin might be the store of value. Ethereum might be the smart contract giant. But XRP? It's the settlement layer of the new financial system. And when the old system cracks, settlement is everything. The calm now is the silence before the storm. Stay ready. Make sure that you like and subscribe this video. It really helps me get the message to the masses and is greatly appreciated.